The EU plots trade revenge, but are markets paying attention? The European Union has yet to decide if it will retaliate against President Trump's tariff policy, yet the bloc is preparing for the worst. A new list of possible retaliation targets is said to be at the ready, worth $84 billion. But are traders similarly prepared as stocks continue to shrug off the latest trade escalations? Atalaf Kasim is the Europe head of investment strategy for State Street Global Advisors. So are markets miscalculating the risks of US tariffs, especially in the face of tit-for-tat retaliation?
Good morning. It does feel like markets are shrugging off the worst case scenario, like you say. And we do think there should be a bit more volatility priced in. As you mentioned, there's a lot of uncertainty, what the US will actually push through with, how other countries will retaliate. And that's really not being reflected right now. We've had a big rally from the post-Liberation Day lows, mostly driven by US large cap tech stocks, but still, it feels like the market is being a little bit complacent right now.
So what's it going to take to see some serious pullback, real negative effects on economic data?
Yeah, I think if the tariffs start showing through in the data, and at the moment they just are not showing up. We've had data from China, data from the Eurozone, data from the US, and nowhere do we seem to see any significant tariff effect. So the first thing would be if it starts to come through in the data. Secondly, if on this case we don't see the taco trade and the US does follow through with, for example, the 30% tariffs that they've announced on the EU, and then we'll have to wait for August the 1st to see about that. And then thirdly, if we see retaliatory tariffs, and again, the EU is playing its cards very close to its chest. But, if we do find that we escalate into a tit for tat, like you say, then I think the market will take that very badly.
So a lot of scenarios are in play. How would you suggest traders position themselves over the next coming months?
Yeah, I think it needs to be a bit of a barbell trade. In other words, you need to have a strong defensive posture. So holding some short-term treasuries, some cash, just to have that ballast against market uncertainty. And then on the more risk asset side, in equities, focus on sectors which should be least affected by tariffs. Those that are more domestically focused, those that have the least export exposure, at least outside the US. And in the US, think more about mid caps or even small caps, which are more domestically focused so that you don't have this exposure to tariffs. But let's just be clear, tariffs, and especially an escalation into a trade war, are bad for all stocks, big or small, domestic or foreign revenue focused. But if you want to try and minimize the effect, then looking for less export focused stocks outside of the US, more domestically focused stocks within the US, more defensive sectors, and really keep an eye on any kind of one-for-one trade agreements that are announced, or retaliatory measures as well.
Meanwhile, Volvo announced this morning it's taking an impairment charge of $1.2 billion due to tariffs. Will this be the norm for other companies during this earnings season?
Yeah, to be honest, I was more surprised that we didn't see more of this happening already in the first quarter. So I do think this could be the canary in the coal mine, and we could see other stocks, specifically in the automotive sector, but in other more tariff-related sectors, start to announce charges to their earnings. Maybe kitchen sinking, as we say, so literally putting all the bad news into this quarter so that they can hide, in a sense, under the veil of tariffs and just get all the bad news out of the way. And I think analysts are a little bit prepared for that, but not that prepared. So if this starts to become a wave, then we could see earnings expectations start to be hit, and that could have a profound effect on the equity market as well.
So finally, the ECB meets next week. How will they be reacting to a possible 30% US tariff?
Yeah, we do feel like the ECB has a lot of room to maneuver. Recently, their rhetoric has been quite hawkish, saying they need to see more progress on inflation, but they need to worry about growth as well. And if we do get a follow through on the 30% tariffs from the US, then growth will certainly be hit. I think inflation is less of a worry. I think, on the inflation side, we're more likely to see deflation continue to be exported from China. So I think the ECB has more room, and they could lean more dovish into the next meeting.
Altaf Kasim of State Street Global Advisors. Don't forget, you can watch more videos on Reuters.com.